All right, let's get you up to speed on another big story of the day, and that's the latest coming out of Fed officials here. St. Louis President James Bullard playing down the risk of a credit crunch. Yahoo Finance reporter Jen Schonberger is here with the details. Jen.
Good afternoon, Shauna. That's right. St. Louis Fed President James Bullard says he doesn't think reverberations from bank failures recently could cause credit conditions to tighten enough to tip the U.S. economy into a recession. On a call this morning with reporters, Bullard explained his rationale revolves around his estimate that only 20% of bank deposits are leaving the system in search of higher yield, and that right now it's not clear to him that there will be much of a pullback on lending. He said as long as banks have enough liquidity and capital, it seems they would make those loans if they were good ones to make. Now, some have suggested lowering the interest rate on the Fed's reverse repo facility could encourage money markets that have been parking cash at the Fed to get a higher yield on the cash they've been collecting from would-be bank depositors, for them to send that cash to banks to try to get cash back into the banking system. But Bullard patting that down, saying, no, we don't have plans to lower the rate on the Fed repo facility. Now, Bullard pegs the odds of 85% that the financial stress is going to abate and the Fed will need to remain more focused on fighting inflation. I did ask him about the JOLTS report, given that we've seen job openings drop to the lowest level in nearly 2 years. Bullard saying that he's not taking much of a signal from that report, that perhaps we could see the beginning etchings of a balancing out of supply and demand in the labor market, noting that if someone loses a job or decides to move jobs, it's very easy to find another job in this environment. Back to you.
All right, thanks so much, Jen.